Welcome to NASDAQ Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at NASDAQ. Joining us at the market site in Times Square, we have Matthew Bartolini. He's the head of SPDR America's Research over at State Street Global Advisors, and we're going to focus on the sectors that are in play following the Fed. Matt, it's great to have you back with us. As always, we got the 25 expected basis point cut. What sectors are you going to be looking at from here?
So obviously financials are going to have a big impact on what happened today. So they've been beaten up for pretty much the last 12 months as the yield curve really flattened and then ultimately inverted. They had a little bit of a positive bounce back recently as the curve steepened. But I think you're going to continue to watch the volatility around that sector, particularly as the monetary policy continues to be somewhat uncertain given the divisiveness we've had today. We're talking about financials. One of the areas we do like because of the less macro sensitivity or rate sensitivity it has is insurance. They actually have a pretty low sensitivity to interest rates, and their earnings growth actually backs that up. So if you're looking to play within financials, I think insurance is one of the areas where you're not going to pick up so much rate sensitivity as you would with, say, like pure banks.
Right. Well, it makes you wonder, when are they going to start to become attractive value plays in the financial space?
Yeah, so broadly financials have been attractive for quite some time, and we've actually noticed a lot of negative positioning. There's been massive amounts of outflows in anything financial related. Obviously within our suite we have some of the bigger financial related ETFs, but we continue to see outflows pretty much over the last 12 months as that yield curve continued to flatten. There's been a pretty strong connection between those two, and yeah, valuations do look attractive, but sometimes you might be a little bit cheap for a reason.
All right, well, let's move on here and talk about where the flows have gone this month within equities. And you're saying that there's a bifurcation of sentiment.
Yeah, so with the relaxation of trade tensions, we've seen some positive flows into technology. There's been a little bit of a reversal over the last 12 months, but tech had a little bit of a bounce back this month. Also, we continue to see concerted flows into utilities, real estate staples, those traditional defensive sectors. Not surprisingly, those three sectors rank pretty high on a momentum screen. So you can kind of see where traders are positioning their money based on momentum. And I think that's really been the bigger story so far this year, is those defensive bond proxy sectors taking in a lot of flows.
Are you seeing money go into dividend sensitive?
Oh yeah, and even when you go outside of sectors and you break it down by smart beta factors, which is how we do it, low volatility and dividend exposures have taken in a sizable amount of overall flows. Pretty much since the start of 2018, dividend strategies alone have taken almost 39% of all smart beta flows. So investors, this bifurcation of sentiment is out there where they're expressing a equity sort of risk-on view, but seeking to have some sort of safety net in case really prospects go south, and you can see that with dividend flows.
All right, let's wrap it up here. Move away from macro and focus on fundamentals. Earnings season is on the horizon. Where are the opportunities?
Yeah, so earnings growth is projected to be negative for the third quarter. I think one of the areas that's been sort of badly beaten up due to a lot of headline risk has been healthcare. Even though healthcare sentiment from an earnings perspective has been strong, their upgrades are much higher than their downgrades. Can't say that a lot about all the other sectors. Their earnings growth is relatively high. It's one of the highest across all the other sectors, and they had really strong earnings surprises last year. I think it's because of the bad price reactions over the past 12 months, valuations are actually now constructive. So it's sort of a sneaky good contrarian type play for investors heading into this earnings season if you're looking for a more fundamentally driven market as opposed to the macro one we've been in for a better part of the last few weeks.
All right, Matt, as always, thanks so much for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.